All right, let's jump right into this explainer and investigate what I think is one of the most fascinating mysteries on Wall Street right now. We're looking at a company that has built a truly iconic income investing story, but there is a massive paradox at play here. So here is the big question. Is Altria's 6++ dividend a powerful income opportunity, or is it a blaring warning sign? We're going to look closely at the numbers behind this tobacco giant to figure out if their massive payout is a genuinely safe bet for your portfolio, or if it's kind of just high-yield compensation for a business in structural decline. To really set the hook here, consider this staggering number. $4.24, that is the annualized dividend Altria currently pays out for every single share you own. Depending on the daily share price, that works out to a roughly 6.34% yield. I mean, it's an enormous payout that completely demands our attention, but to truly understand it, we have to look at how it's actually funded. Moving into Section 1, the dividend machine. The mechanics behind this payout are actually pretty simple, and they really form the bedrock of Altria's entire strategy. Basically, Altria has established a strict goal of paying out roughly 80% of its adjusted earnings per share, essentially their core profitability. Their top priority is maintaining a consistently growing dividend, funneling money from earnings straight to cash flow and directly into shareholders' pockets.
But, and this is absolutely crucial to keep in mind, a high dividend isn't automatically a safe dividend, right? For this whole 80% machine to keep running, the underlying business actually has to generate the cash to support it. You can't simply buy today's yield. You're betting on the company's ongoing ability to fund it tomorrow.
Which brings us to Section 2, the core problem. Now, at first glance, things actually look fine. In just the first half of 2026, Altria generated over $10 billion in revenue, and that's after taking out government excise taxes. This drove a 4.9% increase in their adjusted diluted EPS. So the underlying profitability is still growing, even if it's a bit slow. But here's the record scratch. How is it mathematically possible that first-half revenue is still growing at 3.1% when the company's absolute flagship brand, Marlboro, just saw its shipping volumes tank by a staggering 7.4% in the second quarter? Let's unpack that in Section 3, the consumer shift. This brilliantly illustrates the reality of the consumer's wallet right now. Squeezed American households aren't necessarily quitting tobacco altogether, they're just aggressively trading down. While premium Marlboro dropped 7.4%, Altria's discount brands like Basics surged by an incredible 67.3%. They're trying to catch their own customers on the way down. Furthermore, their historical safety net is heavily being put to the test. For years, they could simply hike prices to offset fewer smokers. But recent data shows those cigarette price increases are actually performing below expectations. If volumes fall and that pricing power snaps, future revenue growth is going to hit a wall. Knowing traditional cigarettes are in decline, let's look at Section 4, smoke-free struggles. Unfortunately, both the past and the future of the company hit major speed bumps in Q2. It wasn't just Marlboro taking a hit. Their big smoke-free bet, the ON nicotine pouch, also saw a 4.2% volume decline. This is super concerning because these pouches are supposed to be Altria's life raft away from traditional tobacco. A massive chunk of this struggle is what we can call the ZYN problem. The nicotine pouch market is heavily dominated by Philip Morris International's ZYN. So Altria isn't just fighting to get smokers to switch to pouches, they're fighting a grueling two-front war to convince them to choose Altria's brand over the already established King of the Hill. So what's their counteroffensive? Well, they're going on the attack by expanding their On Plus pouches to roughly 120,000 stores and dropping new 6, 9, and 12 milligram flavors in Q4. But they face another huge obstacle. Their NJOY Ace e-vapor product is stuck entirely off the US market for 2026 due to an import ban connected to patent litigation. It's a massive headache for their transition. Let's bring this all back to your wallet in Section 5, the payout math. This is where the rubber really meets the road. If you look at management's 2026 earnings per share guidance, the midpoint sits at $5.66. Apply that strict 80% payout target we talked about earlier, and you get a dividend capacity of $4.53 per share. Compared to their current $4.24 dividend, they really only have a tiny 29-cent cushion. That 80% ratio leaves very little room for error if earnings slip. But despite that super tight margin, we absolutely cannot ignore the sheer scale of the cash this company pumps out. I mean, they paid out $3.6 billion in dividends in just the first half of 2026. On top of that, they bought back 5.3 million shares. It is a relentless, massive commitment to returning capital to shareholders.
All right, let's wrap things up with Section 6, the final verdict.
The bulls have a very clear, straightforward argument. They're looking at a steady 6% plus dividend yield, backed by solid single-digit earnings growth, like that 4.9% EPS bump in the first half of the year. With a massive consumer base and aggressive shareholder returns, the bull case basically says if Altria can just stabilize things, this remains an incredibly attractive income play. On the flip side, the bears are pointing directly at the structural red flags. They see Marlboro volumes tumbling by 7.4%, fierce pouch competition pushing on, volumes down, and weaker pricing power overall. Combine that with the NJOY import ban and that rigid 80% payout ratio, and bears argue there's almost zero margin for error if this transition doesn't work out. What you really need to take away from this explainer is that this is a totally different beast than buying a safe utility stock or a treasury bond. The yield sits up there above 6% precisely because the broader market recognizes and is pricing in these exact risks.
Ultimately, whether you see this stock as a high-yield gift or a dangerous warning really boils down to one provocative question. Can Altria replace its declining cigarette volume with higher value, smoke-free revenue before the old business shrinks too far? The answer to that won't just decide the fate of their dividend, it's going to decide the future of this iconic company entirely.